Today I'm going to be doing the midterm from last year, and I'll be showing you how to do all the calculations, and I'll explain all the theory questions. See you! Okay, so first question. If fixed costs increase by 20%, the break-even point in units will be unchanged, lower, none of those, or higher. The formula for break-even points is fixed costs over contribution margin per unit. So, let's say your fixed cost is 6 and your contribution margin per unit is 2. Your break-even point will be 3. But let's say I increase my fixed cost to 8, then my break-even point will increase to 4. So in this situation, your fixed cost would increase. Moving on to the second question. When choosing a cost allocation base for activity costs in a new ABC costing system, which of the following is most likely to be of significance? So, a cost allocation base is a measure used to distribute indirect costs to products, services, or departments based on their usage of resources. The ABC system, activity-based costing system, allocates indirect costs to products or services based on their actual usage of activities. You have to look for reliable and measurable data, since the ABC system depends on accurately measured data which attribute costs to activities. So, the answer is availability of reliable data and measures. So, question 3. The margin of safety at the beginning of a period is A. The difference between actual expenses in dollars and budgeted expenses in dollars. The difference between budgeted sales in units and breakdown point in units. The difference between budgeted expenses and the budgeted break-even point in revenue, or the difference between actual contribution margin and the budgeted fixed costs. The correct answer is B, but I'm going to explain to you why the other ones are incorrect. First one, A, margin of safety is not related to expenses. It's related to sales and the break-even point. So that doesn't make any sense, the first one. This third one, C, the difference between budgeted expenses and budgeted break-even point revenue, the margin of safety focuses on sales, not expenses. And the third one, the fourth one, the difference between actual contribution margin and budgeted fixed costs, is that the margin of safety isn't based on contribution margin and fixed cost directly. Just to show you what the margin of safety is, on this graph, you can see the little points between the break-even point and just above. This shows that the difference between actual or budgeted sales and the break-even sales level. It measures how much sales can drop before a business reaches its breaking point, where there is no profit or loss. A higher margin of safety indicates a lower risk of incurring a loss. Okay, now question 4. A cost object may be characterized as any function that generates a cost, any activity that generates expenses for the organization, anything for which a measurement of cost is desired, or the origin of a cost. A cost object is anything for which a measurement of cost is desired, such as products and departments. So the answer to this would be C. Moving on to question 5. So the margin of safety can be increased by none of these, decreasing sales price, reducing fixed cost, or increasing fixed cost. Well, the only way that you can increase or decrease the margin of safety is by changing the fixed costs or sales. So to increase, you have to either reduce your fixed cost or increase your sales. And here, you can only reduce your fixed cost, so the answer is C. Question 6. Job costing is used when attempting to set prices for identical products, used to calculate percentage of work completed. None of these answers, used by businesses to price unique products for different jobs. Well, the answer is D, because job costing is applied for unique custom jobs or products that are not identical to other jobs or products. They use individualized pricing. Okay, so question 7. Activity-based costing system differs from traditional costing system in the accounting treatment of contribution margins, direct material cost, direct labor cost, or indirect costs. Well, traditional costing systems focuses on only direct costs, so single overhead rates. But the ABC activity-based costing system assigns indirect costs more accurately to products by their activities. This means that the difference is indirect costs. So 8. Shifting from traditional cost system to the ABC method implies create as many cost pools as possible, seeking a lower level of detail, identify the activities involved in a process, or classify as many costs as indirect costs as is feasible. Well, like I just said, ABC focuses on identifying the costing activities to allocate indirect costs more accurately. So here you need to find the activities involved in the process. So the answer would be identify the activities involved in the process. Put the following product costing system implementation steps in the appropriate order. A. Compute the allocation rates. B. Compute the total cost of the products. C. Identify the products that are the cost objects. And D. Select the cost allocation basis. So the first one is C. So this you use in any custom system, and you define what you're costing. Identify the products or services that are your cost objects. Second one is D. Select the cost allocation basis. So these are the factors that drive costs like labor hours, machine hours, or material costs. This links the overhead costs to cost object based on relevant activities. The third one is A. Compute the allocation rates. The allocation rates are calculated by total indirect costs over total cost driver units, such as the activity. Last one is compute the total cost of the products, so B. These are the expenses incurred when producing the product, so direct costs plus the allocated overhead costs, just like we calculated before. I'll show you an example later, so don't worry if you're confused right now. So question 10. What is the prime interest of the break-even point? To simulate the optimal level of fixed costs of the company, to simulate the turnover from which the company achieves a zero contribution margin, to simulate the turnover in which a company achieves a result of 100, or to identify the quantities a company needs to sell to cover its fixed costs. Well, if you look at the graph, here it shows you the fixed costs, your variable costs, and your sales. So the break-even point is to show where your fixed costs cover the sales, so you make a profit of 0. Okay, alright, now for the math questions. BSA manufactures 2 types of products, red and yellow. BSA's fixed costs are 540, red is allocated 60% of these costs, while yellow is allocated the remaining part. Sales of red are 560,000 for 112,000 units. The red unit's variable cost is €3, and what is the net profits or loss for red? So, the first thing I'm going to do is find the calculation for net profit. So, net profit is equal to sales minus variable costs minus allocated fixed cost. So, I already highlighted the sales, which is 560,000, and then minus variable costs, which is 3 times 112,000, because you only have your unit variable cost, and you need to times it by how many units you're selling, and then you minus that from 540,000 times by 0.6, because we're calculating the net profit for red. So, when you do all this calculation, you should get negative 100,000. So, the net loss for red is 100,000. Next question is, the BSA manufactures 2 types of products, red and yellow. BSA fixed costs are 5,450. Red is allocated 60% of those costs, while yellow is allocated the remaining part. Sales of red are 560,000 for 112 units, and the red's unit variable cost is 3. What is the break-even point in sales for value of red? So, the break-even point in sales value, the calculation for that is break-even point times by selling price per unit. So, to calculate break-even, it's fixed costs over contribution margin per unit. And to find contribution margin, it's selling price per unit minus variable cost per unit. So, the selling price per unit is 560,000 over 112,000, which is 5. And the variable cost per unit is just 3, which is given to you in the question. So you do 5 minus 3, which equals 2. Now you found your fixed, your contribution margin per unit, and you have your fixed costs in the question. So the fixed costs are 540,000 times by 0.6 over 2, which is equal to 162,000 units. And because you need it in break even in sales value, it's 162,000 times by the selling price, which is 5, because you found it already, 560,000 over 112,000, and your answer is 810,000. Question 13. So, bedtime essay manufacturers market sheets and duvet covers for a hotel sector. For the month of June N, the indirect costs of the main analysis centers are broken down as follows. You have all of this, and then you have the sales, the production, direct labor, hours, and purchases of each sheets and duvet. The question is asking you, what is the cost allocation base unit for the manufacturing department? So we look at the manufacturing department and we look at the hours of direct labor. So 1,470 and 4,130. You add them together to get your total hours of direct labor, which is equal to 506,000. From here, you take your indirect cost from manufacturing, which is 140,000, and you divide it by 5,600, which is equal to 25 euros. In question 14, they're using the same data for this question, but it's asking you for the allocation base of after-sales services. So you look at your after-sales services, and you look at the allocation base, which is sales. So you look at the sales of sheets and the sales of duvet covers. So 740,000 plus 262,400, which would equal to 1,002,400. Then you look at your indirect cost, which is 13,500, and you divide it by 1,002,400, and it should equal 0.13. Question 15 is also very similar, except it's asking for the general administration department. So you look at their allocation base, which is production costs, which is 503,200 and 178,432. You add those together to get 681,632. Then you look at your indirect cost, which is 37,500, and you divide that by 681,632, which should equal 0.055. Question 16 is exactly the same type of question, except it's just for the marketing department. So you look at the allocation base of your marketing department, which is 100 euros of sales. So you take your sales, 740,000 plus 262,400, and you divide those by 100 because it's 100 of sales. And that should equal 10,024. Then you divide by your indirect costs, which is 13,000. And 13,000 divided by 10,024 is 1.3. Question 17 is new. So company B sells 300,000 units. If the unit's variable cost is 100, the total monthly costs are 300,000, and the unit selling price is 250, what is the contribution margin? Well, the contribution margin is equal to the selling price minus variable cost times by units sold. It's also sales minus variable costs. Here we're going to use the first equation that I just showed you, and we're going to do our selling price, which is 250, minus our variable cost, which is 100, and then times it by our units sold, which is 300,000, which should equal 45 million. Sundance Limited produces chocolate donuts. 20,000 units were sold, generating 55,000 in sales, 37,000 in variable cost, and 8,000 in fixed costs. If variable costs decrease by 0.35 per unit, the new margin of safety is. So the margin of safety is equal to sales minus break even. Break even is calculated by fixed costs over contribution margin per unit. So here, contribution margin is found by selling price per unit minus variable cost per unit. So our first thing that we need to find is our variable cost, which is 37,000 divided by 20,000, which is equal to 1.85. Now we have to find the new variable cost per unit, which is 1.85 minus 0.35 because it's decreasing, equals 1.5. So the new total variable cost is equal to 1.5 times by 20,000, which are the units sold, which is equal to 30,000. So the new contribution margin is 55,000 minus 30,000. Ignore the 50,000 I put there, it was a mistake. Equals to 25,000. So you take that 25,000 because it's now your contribution margin, and you put it over 20,000 so you can find your contribution margin per unit, which is 1.25. So then your fixed costs are 8,000. So you do 8,000 divided by 1.25, which is 6,400. So that means that you can finally find your margin of safety. So margin of safety is equal to 20,000 minus 6,400, which is equal to 13,600. So, but you need to find it in dollars because that's what it asks you in the question. So margin of safety in dollars is just marginal safety times by selling price per unit. So the selling price per unit is 55,000 divided by 20,000, which is equal to 2.75. So then you take your marginal of safety and you do 13,600 times by 2.75, which is equal to 37,400. So, Perfect Performance Inc. is US-based consulting company. It has staff of 70 consultants and administrative staff. Forecast total costs of the company equate to 6 million. 40% of these costs are direct labor costs. Assuming that the remaining costs are indirect and direct labor cost is the allocation base, what is the budgeted indirect cost rate? So, here we calculate how to get our budgeted indirect cost rate. To do that, we divide our indirect costs by our direct labor costs. It's basically telling you what to do in the question. So our direct labor costs are 45% of the total cost. So 0.45 times by 6 million, which is equal to 2.7 million. Then our indirect costs, which are total costs, minus our direct labor costs, because we've already found the direct costs and now we need to find the indirect costs. So total cost minus direct costs, labor costs, is equal to 6 million minus 22.7 million, which is equal to 3.3 million. So in the end, our budgeted indirect cost rate is equal to 3.3 million divided by 2.7 million, which is equal to 1.22. And that is 122%, because you have to times it by 100 in the end, because it's at a rate. So the next couple questions are going to use this data. Pause the video so you can see and read what we need to know, and I'll move on to the question in a second. So it's asking for its contribution margin in 2021. So that is the sales minus variable costs. So the sales are equal to 5,000 times by 6, because you have 5,000 meals and they're at €6 per meal. So it equals to 30,000. So let's break down all our costs. So first we have commodities, which is a variable cost because it says in the thing that cost of food, tableware are expenses that vary proportionally with the number of meals served. So food, which is going to be variable. And that is 17,925 euros. The staff costs, it says that they're half variable, half fixed, which is 28,400. Our depreciation costs are fixed costs, which is 2,760. Our tableware is a variable cost because it says in the data, and it's 1,380. And the miscellaneous is a fixed cost, which is 5,235. So now we take the variable costs. So the staff costs, which we divide by 2 because half of it is a variable cost, plus our commodities, plus our tableware, which all should equal to 33,505. And because we have our sales and our variable costs, we do 30,000 minus 33,505, which is equal to negative 3,505. So in question 21 is asking for the break-even point in sales for tacos mexicanos. Break-even point in sales is found by the break-even point times by the selling price per unit. So to find the break-even point, it's fixed cost over contribution margin per meal. But because we calculated our contribution margin per meal last question, and it's a negative, which means that therefore there's no break-even point because they're constantly making a negative profit. So Mr. Escobar then decides to increase the average price of the menu to 12 euros, which is what is the net operating income with this new hypothesis? So net operating income is equal to contribution margin minus fixed cost. So first we want to find what the contribution margin is, which is just sales minus variable costs. So our new sales are 12 times 5,000 because it's not 6 euros per meal anymore, it's 12. So which is 60,000. Then our variable costs, we calculated them last 2 questions ago, and it's 33,505. So our new contribution margin is 60,000 minus 33,505, which is equal to 26,495. And our fixed costs, we add them all together. So MISC and depreciation and half of staff costs, which is equal to 22,195. And that means that we have both our contribution margin and our fixed costs, which means that the net operating income is 26,495 minus 22,195, which is equal to 4,300. Last question is Compass Inc. sells GPS units at 150 each. Its fixed costs are 350,000 and the variable cost per unit of each GPS is 35. Sales are forecast at 3,000 units. A Chinese supplier offers to outsource production, which would reduce the variable cost per unit to 25 and the fixed cost to 250,000. Compass believes that this new option would allow it to lower its selling price to 125,000 and boost its sales to 250,000 units. What is the difference in sales between the old and new break-even points if Compass accepts the Chinese subcontractor's proposal? So it's asking us to find the new break-even points and the old break-even points. So the calculation for break-even is fixed costs over contribution margin per unit, and contribution margin per unit is selling price per unit minus variable cost per unit. Well, in the question, it already gives us that. So 150 minus 35, which is equal to 115. And our fixed costs are 350,000. So we do 350,000 divided by 115, which is around 3,043 units. Our break-even sales value is 3,043 times by 150, which is equal to 456,450. Our new break-even point, we use the same calculations, fixed cost over contribution margin per unit, and we have all the information. So 125 minus 25, which is equal to 100, which is our contribution margin per unit. And we do 250,000 over 100, which is equal to 2,500. Then we find our break-even sales value, which is 2,500 times by 125, which is equal to 312,500. So then we take the old one and we minus it from the new one. So 456,450 minus 312,500, which is equal to 144,100. Thank you so much for watching, guys. And if you need any help or if you're confused, my DMs are always open. And good luck tomorrow, my boogies.